Hi everyone, and welcome to a video looking at section 2.1 of theme 2, and this is looking at measurements of macroeconomic performance. Now in this particular video, what we're going to be focusing on is this section of the specification. So we're looking at economic growth. So you can see here the different things that you are expected to be aware about for your exam. Right, so what I'd like you to do first of all, again in your writing books, please, is to write down these 4 different questions. So what is an index number? What is macroeconomics? Explain the term aggregate. And then number 4, what are the 4 main measurements of macroeconomic performance? So once you've written down the questions, if you can hit pause and then write down your answers. Once you've written down your answers, click play, and then you can compare what you've written against what I think the answer should be for these questions. Right, so first of all, index numbers then. These are things that we use a lot in economics. Index numbers, then what they do, they allow us to compare how the value of a variable will change over time. And we can make this comparison against a base year. Now, we use index numbers for all sorts of weird and wonderful things. It could be to track how price levels change over time through something called the Consumer Price Index. We might use it to track how economies grow over time through index numbers. We can compare growth in one economy with growth in another economy. We could use index numbers to track how business values change on financial stock exchanges, etc. So it's a really, really useful tool to compare how the value of things are changing over time. Now, to give you an example, you've got in the table on this slide 2 different products, chocolate bars and cans of baked beans. What we want to do, we want to create index numbers to measure how the price of these different items changes over time. Now, what we do, we establish a base year, which is the starting point. So you can see here a chocolate bar in the base year, the starting point was 45p, and a can of baked beans was 39p. We then gather the price levels exactly 1 year later in year 1, and then another year later in year 2. Right, okay, now what we now do, we're going to convert these to index numbers. Now in the base, the starting point, we set both chocolate bars and baked beans equal to 100 index points. Okay, so this is the starting point. We're not saying that they're both equal to 100 pounds or pence. We're not saying they're the same price. We're just saying this is the starting point to measure the change in the price of these different products over time. Now, what we know is from the base to year 1, chocolate bars increased in price from 45p to 54p. So what we would do here to work out the new index number, we do the new price, which is 54, divided by the base, which was 45, multiplied by 100 to get a new index number of 120. For year 2, it's exactly the same process. We do the new price, which is 61p. We divide by the base price, which was 45p, and we multiply it by 100. And what we can see is that the new index number is 135.5. For cans of baked beans, we would do exactly the same thing. So in each year, we take the new price, we divide it by the base, and multiply it by 100. Now, what these index numbers show us is that across those 3 years there, chocolate bars have increased by 35.5%. But the biggest increase in price occurred from the base to year 1, when price levels increased by 20%. Cans of baked beans have increased in price not as significantly. So they've grown across the 3 years by 12.8%. The biggest change occurred from the base to year 1, when they increased by 7.7 index numbers, which of course there will be 7.7%. So really, really useful tool to measure how things change over time. Right, now measurements of macroeconomic performance then. Now, first of all, it's worth noting that macroeconomics is looking at economic variables at an aggregate level. So what we're no longer concerning ourselves with are individual markets or individual parts of the economy. We're looking at the bigger picture. We are adding up all of these different markets together, businesses, households, governments, etc., to look at the total level of output across the economy. So aggregate is looking at totals. adding up all the individual parts of the economy together. Now, there are four main measurements of macro performance. These are economic growth, inflation, unemployment, and balance of payments performance. This video will focus on economic growth. Later videos will be looking at inflation, unemployment, and a balance of payments. Right, okie dokie. What I would now like to do, please, have a go at drawing in your books a fully labelled circular flow diagram. Hit pause once you've drawn it. Again, hit play. Right, so hopefully this is the diagram that you drew. The circular flow of income, output, and expenditure. Right, okay, now if we were to add up the value of all of the output produced by the economy, then we call this GDP, which is the market value of all the goods and services produced within an economy within a year. Now, we can look at the size of the economy or the GDP of the economy by looking at the relationship between households and firms. Now, we should remember from theme one, these are two really, really important economic agents. Households will include workers and consumers, and then businesses, of course, produce goods and services. So what the circular flow does, it measures how big the economy actually is. So when you look at the circular flow, think about what households do. They will supply businesses with factors of production. This will mainly be labor, but it could also be land, it could be capital, and it could also be enterprise. But in exchange for supplying those factors of production, households will receive factor incomes. So for supplying factors of production, you will get some reward. So workers will receive wages for providing their labor. Businesses that are taking land from households will have to pay rent. Capital will generate interests and dividends, and enterprise would lead to profits for households as well. So all those incomes will flow back to households. So the factor incomes is one measurement of the GDP of the economy. Expenditure. So the idea will now be that households, once they receive their income, they will then spend that back into the economy. And that will be to get hold of the output, which is the goods and services produced by the economy. So everyone, the idea now is then incomes, output, and expenditure in this diagram are literally one and the same. They all measure the GDP of the economy. Now, if we were to have economic growth, what it would mean is that the GDP of the economy is increased from one year to the previous year. Now, if GDP grows, what it would mean is it means there's more incomes, which means there's more expenditure taking place, which means there is more output in the economy as well. So economic growth would mean that the circular flow diagram would get bigger. Right, okay, now when we look at GDP, looking at output, it's important that we're aware that we need to focus on the value of the economy as opposed to the volume of goods and services produced in the economy. We don't measure how big an economy is by how much stuff it makes. We don't say, right, the GDP last year was 23 million TVs, 6 million cars, 2 million new homes. What we do, we work out the value of the output produced across the economy. So what we would do, we'd look at the volume of goods and services produced and multiply it by their prices. So what we can do through GDP, we can place a financial or a monetary value on the size of every single economy across the world. Right, so a lot of these things on here we've already covered. Just looking at economic growth, we should now be aware that income equals output expenditure. And all three of these different statistics will give us a rough idea of the size of the GDP of the economy. So if incomes were to increase, then it will also mean that there's more money flowing around the economy, there's more value in the economy. If there's more expenditure or more output, again, then it would suggest that we've got a growth in GDP and we've got more economic growth taking place. Right, what I would now like to do is to think about different types of economic growth. In your writing books now, can you now please draw for me, using production possibility frontiers diagrams, to explain the difference between actual and potential economic growth. Again, hit pause, and when you've drawn them, hit play and compare what you've drawn against what I'd expect to see. Right, everyone. Now, hopefully what you've drawn are diagrams like this. So look at the left-hand diagram first of all. Now, this diagram shows actual economic growth, and this is measured by a growth in the value of the output produced within the economy normally in a year. So in this diagram, what I've done, I've put goods and services on the axes, and we can see the economy has gone from G1S1 to G2S2. So we've got a growth in the output of the economy. Remember, the PPF measures the maximum number of goods and services produced in the economy, or could be produced in the economy. So when actual output moves closer to the PPF, it means the amount of unused resources, or what we call spare capacity, is falling in the economy. Just to make sure we understand that, when we move from G1S1 to G2S2, the economy has experienced actual economic growth. The diagram on the right-hand side shows potential economic growth. If the PPF was to move outwards, then it means that the economy has improved or increased its factors of production. That therefore means that the productive capacity of the economy is now bigger than what it was before. So we've therefore got actual against potential economic growth. Right, next question. Can you now write down the answers for these questions, please? Explain the difference between real and nominal GDP, and then total GDP and per capita GDP. So again, hit pause, and once you've put your answers down, you can hit play and compare what you've done against what I'd expect to see. Right, guys, now real against nominal GDP, first of all. Now, all nominal GDP is the value of all the output produced within the economy in that particular year at that year's prices. Real GDP is the sum value of all the output produced within the economy in a year adjusted for inflation. Now, let's think about why real GDP is far more useful than nominal GDP. Now, what I've done, I've given you a fake economy, and I'm assuming the only output produced in that economy is jumpers. And in year one, the output is 100 jumpers, and they sell each jumper for 10 quid each. That therefore means you take the 100, you multiply it by 10, and you get the value of the GDP to be £1,000 for that year. Year two, we can see the output hasn't increased. It's still 100 jumpers, but now the selling price of each jumper is 12 quid. We multiply the two together, and we've got a nominal GDP of £1,200. Now look at that then. In this example here, nominal GDP has increased from £1,000 to £1,200. That would suggest that the economy has actually grown by 20%. But the problem is the volume of output has stayed the same. It's 100 jumpers. So what we would now do, what real GDP would do, it would deflate GDP by the rate of inflation. So because price levels have increased by 20%, we've got to take that 20% off again, which means that real GDP is still at £1,000 in year two. Okay, so real GDP takes into account the impacts of inflation, whereas nominal GDP takes no account of inflation. So if we want to measure in real terms how much the economy is growing, we've got to use real GDP because that will factoring in the changes in price levels over time. Right, next one was total against per capita GDP. Now this is fairly straightforward. Total GDP is simply the value of all the goods and services produced within that economy within a year. Now, obviously, economies that have got big factors endowment, in other words, big PPFs, will have a much higher GDP than countries that have got smaller production possibility frontiers. So because China, for example, has got over 1 billion people and massive land mass, their GDP is higher than it is in the UK because we've got a much smaller population level. Now, the problem with GDP on its own then is it doesn't really give us an indication about the quality of life in that particular economy. We don't know, how much do individual people get. So what we do instead, we will use GDP per capita. So what we would do here, we take the GDP of the country and we divide it by the population level. And this will give us a rough idea of the average number of goods and services that individual people can consume within that economy. It's therefore a much better measurement of living standards than just GDP on its own, because it factors in the impacts of population. So overall, everyone, for this bit here, what I'm thinking is real GDP is better than nominal GDP. Per capita is more useful than total GDP. Right, now you've got here a numerical example looking at how we measure real incomes against nominal incomes. So we're looking at now real rather than nominal, and we're looking at per person rather than total. So look what we've got here then. Now, I'm not going to go through all these numbers. You can look at this slide on your own and try and take on board all the numbers. But let's imagine we've got somebody who's, so we've got here the UK average weekly wage in the year 2000. So someone working full-time in the year 2000, the average weekly wage was £430 per week. In the year 2020, that wage has increased to £547. Now, if I did the maths, this would show a nominal increase in wages of 27%. In other words, nominally, people earn 27% more in 2020 than what they did in 2000. But across that same time period, price levels have increased by 24%. Well, clearly what that means then is that people are not 27% better off in real terms. Once you account for the impacts of inflation, people are only slightly better off in 2020 than what they were in 2000. So it just shows the importance when you're looking at incomes to factoring in the cost of living. Now you've got here another way of thinking about this. So another way of comparing nominal against real GDP. And we can do with Freddo chocolate bars. Let's imagine the average pocket money in nominal terms was £5 in the year 1990. 2020, it's increased to £13. So in nominal terms, kids in 2020, they're £8 better off than kids were in 1990. But then let's imagine that people only buy Freddo bars with their pocket money. And in the year 1990, a Freddo bar cost 10p. Now that £5 would therefore buy on a weekly basis 50 Freddo bars. So £5, 500 pence divided by 10 pence, 50. So 1990, kids every week could buy 50 Freddo bars. 2020, the price is now 27p. If I do £13 divide by the 27p, I can now see that in the year 2020, kids could buy every week 48 Freddo bars. So in nominal terms, kids in 2020 are better off. £13 is much better than £5. The trouble is when you're factoring in real terms, though, what people can actually buy with that money and the impacts of inflation, we can see it's actually the reverse. Kids in 1990 are better off than what kids are in the year 2020. So real GDP per capita is far more useful than nominal GDP per capita. Right, guys, next bit of this. GDP is often now getting ignored a little bit. Economies now prefer to focus on GNI, something we call gross national income. Now, I've also included on here something called gross national product, GNP. You can more or less forget about this because GNI has more or less replaced GNP. So the one that you're expected to be aware of is GNI, gross national income. Now, the idea is what GNI does, it doesn't just look at the value of the output produced within an economy. It will also factoring in the incomes that our people will earn from overseas, but also take away the incomes that foreign people earn in our economy. Now, the idea is this should hopefully give us a much better idea of how much money is within our economy. So we start off with the GDP, and we then factor in that British people will have made lots of investments overseas. They will own businesses. They will have lent money to people overseas. They might even work overseas. Now, that will therefore mean the output that is made across the world will be creating returns for British people. that will be an inflow of money into our economy. But what we will then do, we will take away what foreigners earn on assets they own within our economy. So, for example, lots of car plants in the UK, like Nissan, are foreign owned. So, when the cars are produced here, it's British output because the cars are made within our economy. But we have to take away the profits because the profits will flow back to the owners of the company in different countries across the world. So, gross national income, everyone, or GNI, will factor in the fact that incomes will flow between economies. GDP doesn't really factor that in to that extent. Right, so GNI is a much better measurement of the income in an economy than what GDP would be. Right, anyway, the last thing before you have another question to do, we've now got to be thinking about something that we call purchasing power parity, PPP. Now, when we want to compare incomes between countries, we've got a problem. Every country, or most countries across the world, will have different currencies. So it's very difficult to work out how well off people are in one country compared to another. So PPP is a really, really useful tool to overcome exchange rate problems. Now, halfway down that page, you will see we have what we call a PPP worked example. Now, look at this. Roughly right now, if you went to change your pounds into American dollars, you would get £1 equals $1.24. Okay, so let's imagine then we look at incomes in America compared to Britain. Now, in America, what I'm assuming is that the average American is earning per year 65,111 US dollars. If I want to work out how Brits compare to American people, I've got to first of all convert pounds into dollars to work out how many dollars people in Britain would have. So, in Britain, let's imagine the real GDP per capita is £41,030. Now, to turn that into American dollars, what I would do, I would multiply it by 1.24. Now, what this shows me is that the average British person at the current exchange rate has got every year $50,877.20. Now, what that means then is at the moment, your average American person has got $65,111 per year. The average Brit has got $50,877 per person per year. So we are roughly $15,000 worse off than the average American person. But this is nonsense, because what we've got to be thinking about is the spending power of your money in your economy. Now, to do this, we often use something called the Big Mac Index. And this is about looking at how much you can spend with your currency in your economy. Now, if we look at a Big Mac in the UK currently is £3.19. In America, it's $5.30. Now, what this therefore means then is to buy a Big Mac in America, the average British person would have to sacrifice £3.19 to get that American Big Mac. The American person would have to sacrifice $5.30 to buy a £3.19 Big Mac. Now, what we can therefore do, we can work out what we call a real exchange rate. We take the price of a Big Mac in America, $5.30. We divide it by the price of a Big Mac in the UK, which is 3.19, and we multiply it by 100. What this shows us then really is £1 is worth $1.66. Now, what this means then is that if you took £1 to Britain, it should really be worth $1.66. Now, what we can therefore do, we can work out the real value of our money based on PPP. So if we now take our £41,030 to £41,030 to America, we could multiply it by $1.66, and that would therefore give us a real GDP per capita at PPP of $68,109.80. This is now actually higher than what the American one is. So look at what we're saying here. With £41,000 in Britain, you could buy 12,862 Big Macs in Britain. 41,030 divided by 3.19. In America, $65,111 would buy you 12,285 Big Macs. So the average Brit can buy 600 more Big Macs per year with their £41,000 than what the average American would be able to. Now, what this therefore means then is that £41,000 average wage in Britain will buy more in Britain than what $65,000 would do in America. Now, based on that, then we would say that the average British person is better off than the American people once you work out the real exchange rate. Right, next two questions. Number 11, does economic growth improve living standards? And then number 12, what is the trickle-down effect? So write down your answers. Hit pause, obviously now, and then once you've put down your answers, hit play again, please. Right, guys, now we are coming towards the end of this video, you'll be relieved to hear. What we're looking at here then is economic growth a good measurement of living standards? Well, think about what it should mean. If economies grow, it means the value of all the output produced in the economy has increased. Now, this should improve economic welfare or living standards because if we're producing more, it means there's more output, which means people can access more goods and services to meet their wants and needs. If we think about the circular flow, if there's more output, that means there's more incomes going back to households. If people are earning more, they can afford to buy more output, save more money, plan for the future. If there's more output, businesses will need more workers, which creates more jobs. And again, this will allow more people to spend and save in the economy. People can buy more property, which means they've got more wealth. And it also benefits the government because if more people are working, more people are paying taxes. And if there's more tax revenue, then businesses will be able to access more subsidies through government support. But also there's more funds available for education and healthcare as well. Now, we also have something we call the trickle-down effect. As economies grow, you tend to find those with the wealth will be the ones that do the best. They get higher profits, more dividends on shares. But then eventually this will trickle down to benefit other people across society. And this could be in terms of more jobs. So people earn more money. It could be that those big businesses that make more profits pay more taxes. So there's more funds available to provide healthcare and education for people. Now, overall, then, what we would say then is that GDP is best when we look at real GDP than nominal GDP. It's also better if we look at per capita rather than total GDP. And it's also better when we allow for purchasing power parities. In other words, we're factoring in the impacts of exchange rates on the ability to buy goods and services. So real GDP per capita PPP is the best thing to use to look at living standards. Now, we do have a problem though. GDP data does often get things wrong. It's not always a fantastic measurement of living standards for the following reasons. And we're going to be thinking about these three different questions. What is produced? How is it produced? And for whom is it produced? All GDP growing shows us is that the economy has got a bigger value of goods and services. This doesn't take into account what is produced. If, for example, all we're producing in our economy are demerit goods, things that create negative externalities, then this is not going to improve people's living standards. We've also got to be thinking about how we produce. If, for example, growth is leading to us using up more non-renewable resources, if it's creating lots of environmental damage, lots of waste, then these things again would not be improving living standards. We've then also got to be thinking about for whom is it produced. Okay, now we're thinking here ultimately, if economies grow, if the additional output is going to the rich and none's going to poorer people, then you would argue for many people that growth has not really created many benefits across society. Now, we've got other problems though with GDP, especially in poor economies. In poor economies, lots of people work in what we call the informal economy. So people work as subsistence farmers, they work illegally, their incomes aren't declared. Well, their data wouldn't form part of GDP statistics, but they've still got an income. So this could mean that GDP is often, in reality, higher than what is reported by the government. Now, as well, we've got to factor in that GDP takes no account of how many cars on the road, like congestion, stress that people have got, how much leisure time people are having. So you've got some real problems of using simply GDP to measure living standards. But what I would say is that there is a correlation between GDP growing and living standards improving, but there's no guarantee that it will create that benefit. Right now, just to draw this stuff to an end, then you've got here alternative ways of measuring living standards. Now, something that we often use in the UK is something called the UK National Wellbeing. And what this will do, it will look at GDP, because that's really, really important for living standards. But it will also look at things like literacy rates, so access to education, mortality rates, so, death rates across society, how well connected people are with friends, partners, and family, state of family finances, have people got savings? Have they got wealth? The quality of government, what is happening with the environment, personal well-being. So all these other things should be considered when we measure living standards in a country. Now, one big problem we've got with all this, though, is that happiness or living standards is very personal, it's very subjective. There is that saying, does money bring happiness? So will an increase in GDP lead to better happiness and living standards across the economy? Now, all the research produced so far does suggest that when economies grow, there is improved happiness. So higher incomes does improve happiness. But there is a saturation point, which means when incomes go beyond a certain level, then happiness will stop increasing or the rate of growth will start to slow. So to a certain extent, higher incomes, higher GDP will lead to better living standards, but there is a limit to it. Right, guys, thank you very much. I will stop the video there.